Hello, everyone. Welcome, everyone. Today we have got a super important live, so twice for today. I was trying to keep some living, like watching some Bloomberg or the Fed channel live, but there is some problem with the audio, with the sound. So let's just wait together for this new. Yeah. So welcome everyone. So the Fed is about to announce tonight its interest rate decision, and the markets, especially crypto, are already loaded with tension. So in just some minutes, 15 minutes, we will get the official decision, and 30 minutes later, Power will speak at the press conference. So get ready for high volatility today, traders. Are you bullish or bearish on crypto right now? Let me know in the comments. The market is dropping a little bit. Yeah, bullish. Everyone is bullish. Yeah, 50-50, 50-50. So what do you think the decision will be, and how will the market react immediately? So quick recap, guys, for those who haven't followed the news. So recap expectations for today grew after the NFP data in early September. So in USA, the inflation is still stubborn at 3%. PPI and CPI from August gave markets some breathing room. So it's some bad data from the job section, and Bitcoin is stuck, Ethereum is stuck, and Solana is stuck. Let's have a look on what they are doing right now on the 5 minutes. So Bitcoin is about 115K, and Ethereum is in, let's switch to 1 hour, 1 day. Okay, it's here is some smart money concept chart. It's dropping a little bit, but is still on top high. So markets, let's move to our Fed watch, and let's see that the markets are already pricing 25 base points rate cut. So as you see, guys, this is the September. The current target rate is 425, 420, 50, and the cut expectation is 25 base points. So the real question is, will Powell sound more dovish or more hawkish in his speech? Let's wait together for the news. So the current expectations, as we see, is like 94% of analysts expect 25 base point cut from 4.50 to 4.50 2025. Almost nobody believes Powell will surprising tonight. Like if we go back in August, expectation were only at 485%. So now the expectation for the rate cut is 94, but 1 month ago was 85. So there will be no a big surprise for tonight. Let's see on October also the next Fed meeting. There is 69.8, 70% of consensus for another 25 base point cut. Just 1 month ago was 47. So we move for 47% to 69% in the next meeting. And December is 65% chance of yet another cut. 1 month ago it was 36%, so even below 40%. So in 1 month the expectations basically double. So that means that market are pricing 3 cuts by year end. Let's have a look on the dot plot. So if we take a look on the dot plot projections, we see that 2025, the average consensus is around 4% for the rate. So that means, as we say, 3 cuts by year end of 25 base points. 2026, the average consensus of the rate is around 37%, and 2027 is around 3-4%. So that basically implies that 1 cut per year over the next 2 years. So do you think is that very possible with all the bad data from the job and the economy and macroeconomy? So it's only 3 cut rates in the next only 2 cut rates in the next 2 years. So it looks quite difficult for the Fed, because as you know, guys, as we all know, the Fed is always late. They only step in after the recession bites, unemployment rises, and households. So they are already hurting. That is when they try to stabilize the system, when everything is already fucked up. So today the signs are already flashing red in the USA. The labor market is showing cracks. No one is buying bonds, and yields, especially on the long end, remain sky high. And quantitative tightening is still in full swing. So if no real changes come soon, the whole house of cards could collapse with a deep recession. So I truly don't believe that this projection will be real for 2026 and 2027. I'm pretty sure that tonight no one will get surprised. but the next years something will happen for sure. So the real game begins after Powell speaks. If he confirms more cuts ahead, market could keep running. So 7 minutes to the data get released. Bitcoin is showing some volatility. And Ethereum is pushing up. Another interesting thing, guys, I want to show you today. I spot this interesting chart we post on our X channel. This is the option volume by strike on the Bitcoin ETF. And as you can see, there is very high volume on puts on the strike at 60. Expiration this week on Friday. So it seems like the market is already boxed, and I don't expect that much move on Bitcoin. So we have $60 on the ETF as a support and 66 as a resistance. So this huge spike is both calls and put, and 66 is mostly put. So that means that, as you can see, there are many investors and traders that they are buying call at 60 price as strike, and many are selling call and buying put at 66. So if you check the current price of the Bitcoin ETF, this is IBIT, so it's the one with the most capitalization. You can track the options, and you can see that at the end of this week, the investors, like the big whales, hedge funds, that most of them they operate by options, they don't expect the price to go over 66 and don't go below 60. And here we also have the table with all the volume and open interest. As you can see, September 19, this Friday, we have expiration type put at 66. 34,000 volume and open interest is the same level. So many are buying put at this level. If we see there is another big number on volume, 52,000 and 78,000 volume and open interest. This is on strike 60. And this is a call. So they are buying call. So they expect that the price will stay above 60 at the end of September 19. Same as on the put 66. Many are truly sure that the price will not go over 66, because if you buy put, you expect the price will go down. So this is interesting information we can keep tracking, and we post here on Alttrading. Three minutes left. Let's see if we can some nice opportunities for a trade.
Surgeon, this is the question I think for the committee today, and for the news conference too, for Chairman Powell. And there was a key difference between how he addressed this question in July and how he's thinking about it over at Jackson Hole in August. What is anchoring your view on the labour market right now? Is it the unemployment rate? Is it measures of slack, or is it payrolls growth? Because the Chairman Powell of July was very different to the Chairman Powell of August.
Who said that it was really important back in July to look at the unemployment rate and then the payrolls headline figure? The problem is right now, people really dispute the idea that we have the same kind of labor market that requires 150, 200,000 jobs created per month, and that this is more of a 50,000 a month kind of break-even rate that we should be looking at.
Do you get lulled into a bigger conversation, a bigger decision than you otherwise would have made? And that's something that this Federal Reserve has to confront today and for the next several months. That decision is 20 seconds away. The question is not if they'll cut interest rates. The question is by how much, 25 or 50, and how much can you project in the guidance, the forecast? Equities going into it just about unchanged on the S&P 500. In the bond market, 2s, 10s.
All right, guys. As we say, nothing change. 4.25% cut rate, as everyone expected.
One dissent, and that is from Stephen Myron, the Trump representative on the board, who wanted no cuts this time. He wanted rather 2 cuts this time, 50 basis points. Next year, the committee sees only 1 cut so far, but the dispersion is very wide. And the very bottom dot for next year is at 2.75%, suggesting once again that is Stephen Myron. The committee sees that the risks to that they are attentive to the risks of both sides of their mandate, but they say the risks to the downside for unemployment have increased, and that's the reason that they are cutting rates today. They also adjust the forward guidance in the statement to drop the word extent and just say in considering additional changes to the target range in the future, they will consider all kinds of options. There is no real change to their economic forecasts, but we don't know exactly why that is, whether it's because Myron contributed different numbers than others, or Anna Paulson, the new Philadelphia Fed president, contributed different numbers than others. But the growth rate is marked up for this year to 1.6% from 1.4%, and the unemployment rate is unchanged at 4.5%. PCE inflation at 3% is unchanged from their July forecast, and core PCE inflation unchanged at 3.1%. There's no change overall to the balance sheet. And once again, there was 1 dissent, Stephen Myron, the new member of the board from the Trump administration. The rest of the board, including Mickey Bowman and Chris Waller, satisfied with moving the rate down to the range of 4 to 4.25%.
Mike McKee, thank you, sir. Stay close. We'll take some time to internalize what we've just heard from the Federal Reserve. A lot of information. Equities off the back of it, still just about positive by 1/10 of 1%. In the bond market, yields just a little bit lower at the front end of the curve, down by 2 basis points on 2s to 348. And foreign exchange, some euro strength, some dollar weakness. We approach 119 on euro dollar, which is its own story, which we'll get to later, 118.84. I want to do a couple of things. Let's take the forecast and just focus on 2025 and 2026. And I just want to focus on where the projections were in June and where they are now. And just go through this piece by piece. For GDP, compared to June, that's an upgrade. For this year, and for next year. For the median dot, we've gone from 3.9 in June down to 3.6 for now. So we're looking for another 2 cuts. For next year, we've come down from 3.6 to 3.4. And PCE has remained pretty stable, I've got to say, for this year. For next year, they're looking at around 2.6%, up from 2.4. So just get into this a little bit more. What an odd decision we've got here, Bramo. That this Federal Reserve, and you don't usually see this, has cut interest rates by 25 basis points, has increased by just 1 interest rate cut relative to where we were in June for this year. At the same time, they've upgraded growth, kept unemployment basically unchanged, and basically projecting CPI to be sticky and close to 3%.
And saying in their statement that inflation has moved up and remains somewhat elevated, as their SEP, their Statement of Economic Projections, suggests. So then why is the bond market rallying? Why are yields down, even at the long end, if this is basically the projection that inflation will remain high and they will cut into that inflation? And what this hints at, and this I think is really going to be interesting, is this clear desire by the Federal Reserve to overweight the economy, even allowing inflation to run hot. And they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come. At the same time, all these other things are happening with the forecast. How can you explain that?
Well, I think there's 2 possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range, and the same is true with the unemployment rate. It didn't move at all, but inflation didn't move. And it seems that Myron probably put in stronger growth, lower unemployment, and at least unchanged or lower inflation going forward, and that probably accounts for the changes in the forecast. No consensus yet on how many rate cuts they're going to want to see, except Mr. Myron thinks rates will go down to the 2.5% to 2% range.
Mike, I know you've got to run, but when you go into that news conference, you're starting to think about questions already. What do you want to know from Chairman Powell?
Well, I think you guys were phrasing it well there in your reaction. If inflation isn't going down, then why are you cutting rates is sort of a basic fundamental question here.
Mike McKee, with the latest, you get ahead to that news conference. It starts in about 25 minutes' time. So we got 25. The Federal Reserve ultimately met the market for 2025. 2026 is a little bit more interesting because this market, Bramo, as you know, is much more aggressive on rate cuts for next year than this Federal Reserve based on the median dot in the Federal Reserve's projection, because as Mike McKee just indicated, the dispersion, which is something you talked about, the spread of the dots for next year is incredibly wide.
And it makes one wonder if a certain dot has a greater weight than other dots, given the fact that the market is moving on the idea of more cuts, even though some of the other dots suggested only 2 cuts this year and relatively few next year. And the Statement of Economic Projections talks about a Fed funds rate that ends next year well above 3%. We are now below that in the futures market.
Something you're interesting, you got a median, you got a central tendency, you got a home in the range and all that. Guess what? There's not a median statistic here above 2%. Is sub 2% economic growth politically acceptable coming up on an election in 2026? I don't think so.
The answer to that is no.
Yeah,
which is why
this is edge of Europe is what I'm looking at.
So
here.
your point, TK, which is why this administration would like this Federal Reserve to be a lot more aggressive than these dots would imply.
Which is the reason why the market is hearing exactly what you're pointing out, that is not an acceptable kind of reality. And that's why I think it'll be very interesting to see how Fed Chair Powell really gets behind this.
Greg Peters, you're following the story as it evolves. What's your initial takeaway?
Yeah, so the initial takeaway is definitely prioritizing growth.
Alcune cose saranno.
Most people, myself included, you'd have
this year. That is speaking volumes about exactly what you just pointed to.
We just took out 119 on euro dollar. Let's head over to Europe and catch up with Bob Michael at JP Morgan in the heart of foreign exchange in the city of London. Bob, great to get your thoughts. You've had about 8 minutes to go over this one. What jumps out to you, sir?
Couple things jump out. Craig's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2 suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts in here, but 25 perhaps every meeting for the next few meetings. Maybe they don't get down to 3% right away. They pause somewhere around 3.5 either side of that. I get that. I'm sort of with the Fed. We don't really know the shape of inflation until we see the final shape of tariffs. Right now, the evidence is pretty good. Businesses have absorbed some of it, and the consumer hasn't really pushed back all that much. And there's been signs of disinflation. So I'm not that concerned about inflation.
Bob, your colleague Michael Feroli made global headlines a long time ago talking about a sub 2% potential GDP. Without COVID, tri-stimulus, and all the rest and the legislation, these median growth estimates today, do we have to get used to this sub 2% real GDP?
It doesn't feel like we're going to have to get used to it. It feels like we live in a world where policy will be generous on the accommodative side, both fiscal and monetary. We're looking at dots now, but we also haven't weighed in. Forget about tariffs. The One Big Beautiful Bill Act, that starts to hit in earnest in the first quarter. So I wouldn't be surprised to see GDP estimates go up next year.
For those of you just tuning in, about 11 minutes ago, the Federal Reserve made the decision to cut interest rates by 25 basis points. There was one dissent, an individual looking for a 50 basis point cut. That was the newly minted Governor Myron, sent over from the White House.
Does he have a business card
the Federal
yet?
Reserve. I want to get to something, CK. Check this out. Go to the dot plot and the projections. And if you go to the dot plot and you look at 2025, there is a very lonely dot at the very bottom of the screen, and it's sub 3%, not for next year, but for this year. There is a dot there just below 3% for 2025. Now, we were all asking, and of course,
heads of retail banking, what we have seen is retailers themselves don't know how much they can pass along inflation, how much there will be this elasticity in terms of demand.
Greg Peters is not clueless. I'm looking at the Bloomberg Total Return Corporate Index, and it is a miracle price up and yield down. Do you predict that we will see these acclaimed indices, the Lehman Barclays, et cetera, now the Bloomberg Total Return Index, they're going to break through and go through the highs of pre-COVID? I mean, we can have a new low yield regime that we just didn't think would occur.
I don't think so. I think that's heroic. I think the world has changed post-COVID. I think the environment of zero interest rates, negative interest rates will continue to be looked back on as a bad idea. That drove those rates to those levels. So
but
I don't
can we go on the edge of Myron? I guess that's the question. Can we find that dot?
I don't think you can get there without a recession, honestly. And I think it's important to remember, the starting place is above neutral. Right. So we're not even at the top of neutral yet. Yep. So, the Fed still has room. They still can get to 4% and they're neutral. Right. And so we have a long way to go. As you get much lower, though, that's where things become really quite accommodative. And I think that's a different question. So I think we're all kind of hot and bothered by this move. But the truth of the matter is we're not in neutral territory yet.
In some ways, this was the easy decision. And every decision after this gets a little bit harder. In equities right now this afternoon, equities rolling over on the S&P 500, so negative now by about 0.25%. Check out the Russell up by 1.24%. The rally for small caps continues. Bond yield still a little bit lower at the front end, lower at the long end. 30s are down by 3 basis points. 2s are down by almost 2 basis points. We've got Bob Michael at JP Morgan still with us. Bob, I want to come back to you. You've just heard from a Federal Reserve, and I don't know what we get in the news conference, but let's just go with what they've told us so far. They're telling us we can upgrade growth, not bring down the projections for inflation, and ultimately offer you more rate cuts. How bullish does that make you as a bond investor?
Aren't they magical? That's all dependent on their policy. If they bring rates down to where they say they're going, they think they are going to cause greater growth and maintain stable inflation. Look, I think there are so many policies in flux on the fiscal side that we don't know yet. I think what we do know is that the labor market was starting to struggle by a greater degree than we all had thought. And we saw that revision and went, and it's time to start relieving some of the pressure on corporate America now.
John, it's 2:16. We've yet to mention tariffs. I find that extraordinary.
So I'm pleased you brought this up, TK, because I think still a lot of people are talking about the tariffs of April as an event and not a process. And I think it's far more important to be open-minded about the process and the potential of pass-through still to come. We know based on the data so far that we aren't seeing the exporters drop prices aggressively. You can see that in import prices. We know based on the data so far that a lot of companies domestically are absorbing this on margin.
Right.
What we don't know is whether they pass on those costs in the next several months and change this inflation picture entirely.
Exactly. And when I look at the Excel spreadsheet from the Fed here and the sub 2% growth, my question is, are we seeing a decline in purchasing power? And that's why you see, the curve coming down and yields coming down right now.
I think what we've seen, Tom, without a doubt, is that we've seen a massive step down in payrolls growth.
Yeah.
That has clearly spooked some members of this Federal Reserve. But Lisa, I think it's key to point out, not all members of this Federal Reserve, that some members of this Fed will still be anchoring their labor market view around what's happening with unemployment, which has been pretty stable through all of this, through the whole of this summer. And look at the forecast from the Fed. They're still forecasting pretty stable unemployment around 4.5%.
Yeah, which is the dispersion. And going back to that is the reason why I'm struggling to interpret the move in markets right now. Because is the market taking their guidance on Myron or on the idea that there are Fed officials who are pushing back and saying, actually, we need to be tighter? Right now, is this a trial balloon for what it would be if there was a Fed that was being more aggressive? Or are we not there yet? I mean, that I think is going to be a tell in terms of, does the bond market behave if it believes that a Fed is willing to really prioritize growth in a significant way over inflation?
Hey, Bob, good to catch up as always. Bob Michael there of JP Morgan. Lisa, let's turn to Dan Swong of KPMG. She's standing by. Dan, welcome to the program. So much to process here going into this news conference in about 12 minutes time. What's your number one issue going into the presser?
Well, first of all, it's really clear that Powell corralled the cats, and I assume that Waller and Bowman did not dissent in part because of the strong retail sales data, which also revealed inequality and something else that's going on out there, and that is that spending on restaurants went up after adjusting for inflation. Spending at grocery stores actually fell after adjusting for inflation and the retail sales numbers. And so you've got this sort of, the K-shaped economy we keep talking about, the bifurcation, but that masking the underlying weakness in lower and middle income households. So this was clearly an acknowledgement that, yes, the labor market has weakened and they want to shore up the labor market. What surprised me as well was that we had heard the Fed talk about a reduction in what they thought the neutral rate was. Powell had referred to that there had been some discussion about that in previous meetings. That did not show up in the forecast. And I think that's important as well because they're removing restriction now. It's not just calibrating down because the neutral rate has moved down. They're trying to say, listen, we're removing some restriction, acknowledging the weakness in the labor market, want to shore up the labor market. But if you really do read this sort of through to next year with a major change in leadership at the Fed, you could have a situation where you overstimulate and get a more pernicious and self-fulfilling prophecy on the fact that consumers and firms now expect inflation to be higher. And I think what the Fed is struggling with is that consumers are also telling them in their own surveys that the job market's the worst it's been on record since 2013. That's something that has got to have startled the Fed as well.
Diane, this is without a doubt a very confusing economic time. It's also a very confusing time when it comes to the Fed's reaction function. Do you have a clear sense of how the Fed is going to prioritize incoming data, whether it's retail sales or jobless claims, or whether it's the payrolls report, and decide how much to ease?
It's really hard. This is, it's one thing for the Fed to have forecast the stagflationary mild bout of stagflation that they did since March. That's gotten more stagflationary over time. That was hard to forecast. It's another thing to live it in real time. And that's what we're doing. And unfortunately, it is very hard to not. You have to shore up the labor market a bit. That said, right. You don't want to remove so much accommodation that you allow these waves, as we heard earlier. I mean, the idea that these are an uneven rollout of tariffs, so it's not just one and done. And Powell was careful in his Jackson Hole remarks on that too. It's not all at once. It's coming in waves. That reinforces the idea that we're going to normalize inflation, which becomes its own self-fulfilling prophecy. And the Fed really has to be quite cognizant of that.
And Diane, you own the study of Michigan, Chicago, and down south down the Mississippi River. The mail I get is people are flat on their back in this K-shaped economy. How does Jerome Powell address the have-nots of America? They don't have AI. They didn't buy NVIDIA like John 3 years ago. What do we do with the people that aren't participating in the system?
Well, it's really the inequality is getting worse. We know that. Actually, Moody's just came out with an updated estimate on some of the inequality, and the top 3.3% of households are really doing really, really well. The top 20%. A little bit better in terms of gaining spending since 21 relative to inflation. The rest of the economy, the bottom 80%, pretty much flatlining it since after adjusting for inflation on their spending patterns. That's a really tough position to be in. And it gets to the heart of what we're still dealing with is the embers of the pandemic inflation. We're still smoldering when you added on the tariff-induced increases in prices. And that's what's really tough for the Fed to deal with and for the average American, because remember, even when the labor market was much more robust, when inflation flared, the majority of Americans believed we were in a recession because their purchasing power was eroding and they were losing ground. And I think that's very important because it really gets to the corrosive nature of inflation. And at the end of the day, you cannot get full employment sustained unless you really derail inflation. What we don't know is if this will just be a couple steps up and then just come off, or if it will be more persistent. And that's what he's going to have to emphasize at the press conference today, is that they're going to be mindful to watch what's coming on in terms of how persistent the inflation becomes and how much.
Right, guys. So 7 minutes left to Powell's speech. The market is reacting quite strongly, as we can see in 3 minutes chart. Bitcoin, it looks like it has found a support on 115,431. So 7 minutes left. Let's see Powell if he will bring more volatility. But right now the market is quite shaking.
The labor market. And so this is all about risk management. It's not about modal forecasts at all. As you noted, growth is stronger, the unemployment rate unchanged for this year, inflation unchanged for this year. You can see it at the back of the SCP, their forecast. There was a little bit of a shift in the distribution of risks. Those officials that are more worried about downside risk to the labor market, less officials that are more worried about upside risk to inflation. It's basically in line with what we were anticipating. The Fed shifting in a little bit more dovish direction today, close call on the 2 versus 3 dots. I think the key question for Chair Powell is how much does he lean into the near-term signal of cutting at each meeting this year?
Do you get a sense, Matt, of how much the reaction function has shifted? John's done a really great job of talking about how from July to August, there seemed to be a shift from the unemployment rate to the headlines, payrolls report. Do you have a sense of just how tolerant this Fed is going to be of inflation well above 2% for years on end and keep cutting?
Bitcoin is pushing up target 116. Let's see if it will reach that level to grab some liquidity. Big resistance there, and support is quite strong. It's quite strong.
Lower Fed funds rate. I think the reality is we are now projecting at 5+ years of inflation being at least 50 basis points above their target, and yet they are cutting rates into that environment. So I think it's a Fed where, as long as there are no worries about the labor market, they can be hyper-focused on inflation. But once some of those concerns about the labor market really manifest, you see a pretty dovish shift. And I think that's what we saw from Chair Powell at Jackson Hole, and we're seeing it manifested now through the dot plot.
Matt Lazzotti, Diane Swank brought it up, and many others have as well. We're all focused on tariffs and substitution. Are we seeing a decline in purchasing power here? Is there an income effect from tariffs that the Fed has to fold in? And what is this, John? 50 more beeps they're going to do by the end of the year?
Potentially, yeah. Widespread of estimates, though, TK.
Win one of them,
125.
TK, Spurs are doing all right.
Yeah, they are. It's
doing all right.
Matt, purchasing power here. This is a huge issue for Americans, isn't it?
It is, no doubt. But I think the main area where you would first see that is through consumer spending data. And I take Diane's point and the points earlier that there's great dispersion around that data, with that being driven by higher income households. At the same time, GDP growth is tracking above 3% in Q3. It was above 3% in Q2. Retail sales are robust. CapEx growth was strong. So I think it's a Fed where, even if you are seeing it eat into disposable income growth, consumer spending growth in the aggregate is strong, and monetary policy has one blunt tool, which is the Fed funds rate. So really, they're not apt or really able to get at a lot of those distributional issues. I think Chair Powell and the Fed would probably tell you that is more up to fiscal policy, tax and spending policies that we would see from the administration. So I don't think that this is really about trying to alleviate some of those distributional concerns. I think it's concerns about the aggregate labor market, which is not being manifested in strong growth at this point in time, and them just trying to get ahead of it and taking out some insurance against that.
Matt Lazzotti, appreciate it. One of the best, Matt. Thank you, sir. Matt Lazzotti there of Deutsche Bank. The news conference a few minutes away. We often hear people come on the program and say, I expect it to be dovish, and really the response to that should always be dovish to what? Relevant to what? Relative to who and what and where? Relative to the market, this isn't dovish. Of course, we were looking for really bullish expectation for rate cuts in the next 12 months or so, but it's their own forecasts that make this dovish. The fact that the Federal Reserve is coming out and telling you, you know what, Lisa, next year, I expect a better picture for growth. I expect a slightly higher inflation print than we did a few months ago. But you know what? I give you some rate cuts to the mix as well. That's basically what the Federal Reserve has communicated in these forecasts today.
Yeah, the currency markets are hearing that loud and clear. And I think that is the biggest tell. And I keep going back to that with the Bloomberg Dollar Spot Index now at a new post-2022 low. We have seen it completely weaken, fall versus some of its counterparts. Why? Because of this prioritization of growth over inflation by the FOMC and a reiteration of that in this SEP.
Greg, I got to ask you a basic question. You've been doing this for a few years. When you read sell-side literature right now, economic think tank literature, can you trust the forecasts?
Well, yes. I mean, I think forecasts are always fraught. The dot plot is no different than a sell-side forecast. It's not like they come with any additional information. But I think in this particular period, when there's so much going on, and I hate the word uncertainty, but it is the right word. I mean, we've been talking about tariffs as an example. We have a Supreme Court decision coming. We don't know what the shape of tariffs is going to look like after that, just as one example. So it's a really difficult environment. So you should expect to see more dispersion. What the markets are trying to suss out, what I'm trying to suss out, is what's real and what's political. And I think that's an open question, and time will tell on that front.
Is the political real?
Well,
Aren't
the
they
political
ultimately
is
gonna be-
driving the real.
They're going to be the same thing next year, aren't they?
Yeah, no, absolutely. And I think this is the world, or this is the investment realm that we have to deal with. And so it's not going to change anytime soon. But this was an incredibly dovish SEP and dot plot. And the markets start responding in kind.
We don't know for sure who that dot actually belongs to at the Federal Reserve. You can have a decent guess. Sure. They're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say, that's Governor Myron, it does not matter. Isn't that a hint, a flavor of what could be coming further down the line in 2026? Isn't that ultimately what the Fed share dot could look like in the next 12 months?
This is the reason why I do believe, based on the market activity, people are putting a disproportionate amount of weight on that dot and on the view, on the dissent, because it is a flavor of who that new Fed chair could be.
We're close to Powell
how
coming out as quick as I can. The markets will police the politicians in Washington.
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are, as he correctly said, Greg said, we're above the neutral rate substantially. They got wiggle room here.
This decision is the easier decision. Without a doubt, we're on the same page on that front. But if anything, you could talk about this Federal Reserve falling into the hands of political actors. This Federal Reserve hasn't hit its inflation mark for years, led by the chairman of the Federal Reserve, Jay Powell.
All right, guys, Mr. Robot is showing. Let's see the market reaction.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today, the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators. In the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 0.25 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, and then just as a quick follow-up, I'm sorry, can you, you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on unemployment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, but that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the effect, basically because of the effects on goods prices from tariffs,
Buyers are coming in.
Those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much every forecast, all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago, The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do. We have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension.
Look at the orders, guys.
How do we decide?
Buyers are stepping in.
Tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of a more neutral policy.
Concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. As you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of this the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based on, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So in the overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with response rates. It's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies. How many go out of business? How many are founded? And it's just really hard. You can't survey for that. You've got to have a model that predicts that. It's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues with that data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both out of the government. And it's a great secret. We want higher response rates, and we need those to have less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second, certainly the third month. So it's not that we don't get the data, it's just that we get it a little later. But
for benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut right here?
We have to live life looking through the windshield rather than that rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. We took that appropriate action today.
Thanks, Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. The black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, high rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I had to say that I thought a quarter point would make a huge difference in the economy, but you got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature, rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore. Don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review.
We're certainly open to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they have in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Andrew.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Thanks.
Katerina.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret what you guys are saying?
So there's 12 voted, 19 participants, of whom 12 vote, as you know, on a rotating basis. So no one voter can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now reality, and there's clearly more downside risk. So I think that's broadly accepted, and so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times, but from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation is running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. There's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly. And that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that the supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Well, if I may, you mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected than what we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So. We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that they do have to be pretty big changes for it to matter a lot, for the big changes in rates for to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual, and so I don't know any forecaster anywhere really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are. And we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Yeah.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just follow up. This rate cut is coming at a time when the stock market financial markets potentially fueling a bubble.
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously, but from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture. We're really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question. Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you could talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So, as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So, if inflation goes up, inflation expectations will predict that it takes us a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also mention and discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. I don't. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
Thank you.
Thanks very much.
That wraps up the news conference with Chairman Powell down in Washington, D.C. Here in New York City, we're reacting to a 25.
All right, guys, the speech is over. Powell is going out, and as everyone expected, he just keeps saying the same thing. So no surprise. The market, I'm sure, is going to get stabilized soon at the end of this trading. And thanks for having watched this live. And if you want to stay up to date, just make sure to subscribe to the channel. I wish you a good trading session. As you can see, I draw some setup for my trades, and see you the next time. Thanks, everyone.